Hello, and welcome to my presentation of the Walt Disney Company, its diversification strategy in 2012. The Walt Disney Company's strategy consists of a mix of related and unrelated diversification strategies. A related diversification strategy involves companies that possess competitively valuable cross-business value chain and resource matchups. In the case of the Walt Disney Company, they have multiple resources that are shared among most all Disney lines of business, which include their characters such as Iron Man, Spider-Man, Mickey Mouse, and many others. Not only does the Walt Disney Company strategy consist of related diversification strategies, but they also combine this with an unrelated diversification strategy. This strategy is evident as Disney has taken in many acquisitions of well-established companies to continue the growth and development of the Walt Disney Company as a whole. Some of these acquisitions include ABC, ESPN, Miramax Films, and Pixar. In this slide, Disney's business units are given an overall weighted industry attractiveness score, which shows their level of attractiveness based on the industry measure and its corresponding importance weight. Here we can see that on a scale of 1 to 10, with 10 showing the company to be very attractive, that consumer products shows to be the highest scoring business unit with 8.65 overall score. In all lines of business shown here, they all rank on the higher end for industry attractiveness, making them good prospects for long-term performance with the exception of interactive media, which has been a struggling business unit for Disney. The Walt Disney Company is also scored on overall weighted competitive strength, which determines how strongly positioned they are in their respective industries. Just as with the weighted industry attractiveness score, the competitive strength scores are calculated in the same manner. Parks and Resorts scored the highest with an overall weighted competitive strength score of 9.0. This is not surprising since Disney World, Disneyland, and their cruise lines are the second largest revenue maker for the Walt Disney Company. Using the 9-cell matrix, we can see the strength and level of industry attractiveness by charting the two scores from the previous tables and placing them on the 9-cell matrix. Most of Disney's business units rank in the top cell for high industry attractiveness and strong competitive strength and market position, with the exception of interactive media, which ranks in the low priority. Overall, Disney's portfolio of business units exhibit good strategic fit. Some of the value chain matchups include primary activities such as staff or employees and actors, consumer goods, and entertainment, while the support activities are training for employees, licensing of consumer goods, and high-tech equipment. In reviewing all these Disney business units, Media Networks tops the revenue list for 2012 at just over $6.1 billion, followed by Parks and Resorts at just over $1.5 billion. The remaining three units contributed $618 million from studio entertainment, $816 million from consumer products, and a $308 million loss from interactive media. Priorities for resource allocations should be focused on the interactive media unit to begin gaining a positive income from this business unit. Disney's financial performance continues to grow with increased operating profit margins from 17.67% in 2010 to 19.03% in 2011. Net profit margin, net ROA, net return on stockholders' equity, and basic EPS all increased as well, showing financial strength and increased growth. The liquidity ratios show a slight increase in the current ratio in 2012, which shows the company's abilities to pay their current liabilities with their current assets. Working capital has also increased, giving the company more internal funds for expansion and current liabilities without having to borrow additional funds. Leverage ratios remain low, indicating good use of credit debt and better credit ratings. The Walt Disney Interactive Media Business Unit has suffered year over year with an operating loss. To reverse this, Walt Disney Company needs to create their own gaming console and make the younger generations their target market. Another area that Disney needs to expand into more is in development of apps for social games and videos. With most people now having smartphones and tablets, being able to access content on the go is important for most consumers. By catering to the changing environment of advanced mobile technology, Disney has an opportunity to see increased revenues in their interactive media division. This concludes my presentation on the Walt Disney Company.